Well, this will be a fantastic conversation, everybody. Give me a second. Let me make sure we're streaming properly. I have been back to back on calls all day long, and this is my second podcast of the day, but I'm excited for this one with Hal Lambert, especially given his expertise when it comes to all things MAGA, political. MAGA, why not, right? If any of you are watching this on X, YouTube, LinkedIn, any of the platforms, and you want to engage, ask questions, don't hesitate to post on whatever platform you're on. We can see your comments. We can see your questions. Let's make this as interactive as possible. I think there's so much that we can get into. I don't even know if the full hour is going to cover it, but please, everybody, stay tuned. It's going to be a lot of good back and forth here. This will be an edited podcast under Lead Lag Live on all of your favorite platforms. This conversation is sponsored by Point Bridge, which is Hal's firm. We're going to be talking about his services as an advisor, as well as his MAGA ETF, which could be a nice 4 years for that product. So with all that said, my name is Michael Gaia, publisher of the Lead Lag Report. Joining me for the Rough Hour is Hal Lambert. Hal, this is, I think, the third time you and I have been doing this, but obviously a lot's changed in the last several weeks here. But for those who don't know your background, introduce yourself. Who are you? What have you done throughout your career? What do you do now?
Yeah, thanks. I appreciate it, Michael. For those that don't know me, I started my firm Point Bridge Capital about 11 years ago after two different firms on Wall Street, JP Morgan and Credit Suisse First Boston, where I was a portfolio manager. So I've been in the investment business basically my whole career. And I have an independent RIA where I do both public and private investing. And as part of that, I launched this ETF about 7 years ago. It's a little over 7 years ago now. And it was during Trump's first term. And of course, I think myself, certainly, and I'm sure many people on the call are very happy that he's now going to have a second term. But the ticker is MAGA, M-A-G-A. And it's the America First, Point Bridge America First ETF. And it's we're going to talk a little bit about that, obviously, today. But there's a lot of reasons I started it, but mainly because of really what we've seen play out over this Biden administration, which was just the total takeover by the left of everything from in the commercial markets for the most part. But there really wasn't anything in the marketplace for conservative ETFs or Republican type ETFs. There was a lot of ESG investing and everything on the left that you can imagine pushed by firms like BlackRock, but nothing on the Republican side. And so that was a big part of the catalyst for me to launch this. And it's now got a 7-year track record. I feel it's done extremely well. We can get into that, but and I can go into all the methods around how it's created as we move along. But obviously, I'm very happy about what happened a couple of weeks ago, and I think it does create some real shift and opportunities within the market as a whole, because the Trump policies are going to be very different than the Biden policies. A lot of people don't realize this, but just this year, the Biden administration had implemented through basically executive order in the agencies over $1 trillion of new regulations. So, I mean, those are the kind of things that are going to be unwound. Many of them obviously haven't even started, but those are not going to move forward. I think it's really going to free up the marketplace from a lot of overburdened regulation, which is why you've seen the market rally and even continue to rally today after starting off down a little bit. But this is clearly a Trump rally going into his next term, and it's based a lot of it is going to be based on the fact that this burdensome regulation is not going to happen, and they're clearly going to unregulate much of the economy, which obviously slows growth and hurts earnings.
As I recall, with the first term, Trump in the beginning was adamant on the idea that for every new regulation, there should be a removal of 2 regulations or something like that, that it was just sort of a net effect that was negative. Let's talk about deregulation from the first term to what you think is going to be coming in the second term. How much more aggressive or maybe less aggressive do you think Trump's going to be?
Oh, I think it's going to be much more aggressive. And I think if you look at what's going on, quite frankly, and he would admit this too, he's much more further ahead than he was the first time. In other words, the people he's going to be putting in place, the people he's identified to come into the administration are certainly night and day from the first term, where he's way ahead of where he was. And so I think he's going to be able to hit the ground running much faster. He also has this thing that happened from his Supreme Court. It was the Loper decision, which happened this past summer, which overturned what was known as Chevron deference. And what that was for everybody out there was it's a big deal, and it really hasn't gotten a lot of news. It did at the time. It got about 2 days of coverage, which is quite a bit for this, for our very limited ability to focus on things in the news cycle. But it overturned Chevron deference from 1984, which said that if a government agency like the EPA or the SEC or any of the hundreds of government agencies had placed a rule in place that the courts were going to defer to that agency against corporate America or against small businesses or against individuals, all of the above, they were going to defer to that agency as the experts, even though it wasn't in the law. So the agencies were effective, given carte blanche to write laws, even though that's Congress's job. Well, Loper overturned that. And so now you're going to see a lot more pushback from corporate America and others saying, look, this is not in the law. You can't make me do this, and therefore fine me if I don't. As an example, if you look at, let's say, the large brokerage firms, they were all fined last year millions, tens of millions of dollars. Many of them were, I say all, but many of them were, because some of their brokers were texting with clients, and it wasn't going through the right channels and all those kind of things. That's not in the law. That's just simply a rule that the SEC has written, that FINRA's written. So it's they quite frankly they went in and went after those firms and fined them millions of dollars that goes to their agencies, by the way, that funds their agencies. So those are the kind of things I think going forward you're going to see pushback on. And so with Trump coming in, he can simply slash and burn on these agency rules that are regulating these companies. And there's really going to be the problem was you could come in and change it, and then a new administration would come in and they just put the rules right back in place. So corporations it was really confusing and hard to deal with. That won't happen going forward because, again, Loper has overturned that. Corporations can now sue and go, and the courts are going to have to rule in their favor because they're clearly going to say, look, this isn't in the text of the law. It's also going to make Congress have to do their job, which many times, they would write kind of broad strokes around, let's say, healthcare legislation or, the Obamacare. And then they'd leave it up to the agencies to, go in and write the rules. That's going to be hard to do now. They're going to actually have to go in and specify, okay, if this is the law, what does it mean? Versus we're going to create this kind of high level law and then let the agencies go out there and write all these rules. So again, I think it's going to really open up, corporations to be able to go out and not spend so much money and time. And believe me, I know a lot of people in the public markets, they are spending board time. They're lots of employees just trying to do paperwork to file for regulatory agencies that I don't know if anybody even reads. So, I mean, that's what's going on out there right now.
What industry groups or just broad sectors do you think will disproportionately benefit from deregulation in general?
I think hands down, it's going to be financials. The banks are so overregulated. That's where I've focused. I started to put some money into banks again. I think, and you saw the day after the election. Some of the larger banks, JP Morgan, some of those were up like 8-9%. There's a reason for that. The markets realize this. I think the mid-sized banks are going to have a great few years here because first of all, they'll probably be allowed to do mergers again, which had been shut down. You've seen there's been very few mergers out there because couldn't get any approvals for mergers in any industry. And you're going to see that happen up. So you'll see M&A happen. That's one of the reasons, Goldman and some of these others are up. But I think the regulatory side with the banks is going to, if you're JP Morgan, you know what, you can afford a lot of the regulatory stuff. You've got, $1 trillion of assets and all those kind of things. You can afford it. If you're a mid-sized bank, you're getting crushed. It hurts your earnings. And those kind of firms, those kind of banks, I think are going to really benefit. It'll take a little time, but you'll see over the next, if you want to get ahead of it, in my opinion, I think the financials are going to be a great place to be. And obviously you could add, oil and gas as well. Now, oil prices are going to, I think that's going to be a big focus of Trump to get oil prices down. So I do think oil prices will come down, which will help the overall economy. And it'll bring down inflation because obviously oil and gas are in everything that we do. So I think that's going to be a big focus of his. But the oil and gas companies themselves are going to have less regulation. They're going to be able to drill more. They weren't, no matter what the Biden administration says, and they can say all day long, oh, there's more oil produced now than when they started. Look, they were not allowing permitting to drill. I mean, they were doing everything they could to stifle it. So that kind of thing is going to come to an end. So companies will be able to drill again, which even though oil prices come down, a sweet spot for oil prices is probably $45 to $50. Oil companies can make a lot of money at that price point. They can drill new wells and make money, and yet the consumer can benefit as well. And I know a lot of oil executives, they weren't happy. They don't want $100 oil because they know what that does to the economy. Even though it boosts their earnings in the short term, they know what it does to the economy. They know what it does to individuals. So I think most of them are perfectly happy with $45 to $50 oil, as long as they can get some of the regulation off their back and the cost of that.
It's interesting because I agreed on the financials, and that should be a big tailwind for value style investing for mid caps, small caps. Do you think that the next 4 years will see mid caps and small caps, because of that deregulation, maybe finally be the winners instead of it just being a large cap only story?
I think that's a good point. Yeah, I think you could see that. I mean, it does help small caps. Plus, again, if you can get some M&A going, people will start to look at the smaller companies and, okay, who could potentially be bought by larger companies? But small caps have lagged tremendously. But, at the end of the day, Michael, kind of going back to my ETF, the S&P is, as we all know, has been driven by a handful of stocks, 6, 7 stocks, but it's even more than you realize. So if you look at, for instance, my ETF versus, which is an equally weighted ETF, versus the S&P equally weighted, it does a lot better than the equally weighted S&P. The equally weighted S&P, meaning, obviously that you have everything at the same percentage. You don't have a cap weighted where it's, Microsoft and Google and Meta and Amazon are all, 3, 4, 5% weightings. If those are all the same weightings as everything else, they actually don't. The performance of the equally weighted S&P is much lower than the cap weighted. So my point in saying that is that it drives home that big tech has driven the S&P higher, not the stock selection of the S&P committee, not the rest of the S&P itself, but just big tech. The overweight, the massive 30%, 35% weighting in tech has driven that performance. And if you break it down, from that standpoint, there's other areas that I think could do better, especially if you look at both sides of Congress are probably not happy with the big tech companies right now. We saw Mark Zuckerberg kind of step back and say he wasn't going to get involved in this election. He probably saw, because he has more data than, if you look at it, there's a handful of people that have all the data. Jeff Bezos, Mark Zuckerberg, the guys at Google. He probably saw the handwriting on the wall before anybody that Trump had a real shot of winning this. And I think he wanted to stay out of the crosshairs. But they're going to be in the crosshairs, I think, of both sides. So I think you could see some crackdowns on what tech is doing within their business models. And so you could see a period of time here where certain tech companies don't do quite as well. AI is kind of offsetting those risks a little bit. So I'm certainly not here saying don't be in tech at all. I'm not saying that. I'm just saying there could be some opportunities for other areas. And again, I like the way my ETF's positioned because it's very heavy in industrials. It's 18% in financials. It's got a lot of oil and gas, a lot of materials, and very little tech. So as far as people looking to adjust their risk profile in their portfolios, I think they ought to definitely take a look at the Maga ETF on that.
By the way, I agree. I'm not saying that just because you're a client. I do actually believe very much so that we're entering a period where equal weighting makes more sense anyway, right? And we're entering a period where having less tech exposure is what's going to define performance in general, because it's been very hard to beat the S&P 500 because of the large cap side, because of the tech side, and there are still cycles, right? And it so happens that this may have sparked a whole new cycle. Now, I am curious to hear your thoughts on healthcare here. There's been a lot made around Kennedy. I'm a little bit skeptical that he can affect that much change because we all know there's going to be all kinds of legal battles with whatever he might try to push down the pipeline. but some of the healthcare stocks have gotten fairly hit. What are your thoughts on Trump administration and healthcare performance in general?
Yeah, that's a very good point. I think one, he's got to get through confirmation in the Senate, which I think he will. But believe me, the tech companies, the drug companies are just as powerful as the tech companies when it comes to lobbying, because quite frankly, they've been at it much longer than the tech companies have. They've been entrenched in there for a long, long time. So you've got these drug companies that are going to be lobbying heavily, probably one to stop Bobby Kennedy from getting confirmed through the Senate. That'll be the first thing they'll try to do. And then from there, they've got all their bureaucrats in there. So it is going to be difficult for him. I mean, he's going to have to really get in there. And I think probably, I'm just guessing, I have no idea. I suspect one of the things he'll do is use the bully pulpit and the microphone to try to expose certain things that he sees is either corrupt or problems with approvals of drugs or approvals of vaccines. But overall, those drug companies, they still have their drugs on the market. And if I don't know what Kennedy's view is on the FDA as far as expediting drug approval. But it certainly still takes a long, long time to get drugs through the pipeline. I think that's a big problem within the whole system, is the FDA takes a long time, and that's caused some, I don't want to use the word corruption, but it's certainly caused some cronyism around that. So it's a long process, and the drug companies have kind of outsourced a lot of that now to other companies, and it's just all about marketing the drugs. So are they going to be able to get a ban on drug marketing on the big networks? That's one of the things that's been discussed. Obviously it can be done. It's legal. They did it with liquor. For a long, long time, you couldn't advertise, hard liquor on any of the networks or cable. You never saw those ads. You certainly don't see it with cigarettes. You don't see cigarette ads. So could they do it with drugs? They could. And would that hurt the drug companies' ability to sell their products if they don't have advertising? I don't know that it would, but it's a way that they've kept skepticism off of them because they're big, effectively clients of these networks. So they're hesitant to run negative stories on the drug companies because they're some of their largest advertisers. That was one of the points that Kennedy was making. So I think drugs will probably not have a lot of upside, in my opinion, when it comes to probably the next 6 to 9 months as people try to figure out exactly what can and can't be done. But I suspect you're right, Michael. I don't know that there can be a huge amount of change from the standpoint of existing drug companies. I think he's going to go more after some of the funding that's been going on within the government, and some of the, obviously his big thing is vaccines and food. I think the food companies, there could be issues there. Will he go after, and again, I don't think he's going to go after necessarily fast food, but he wants to change the way that the seed oils and the other things are done, which make the product cheaper. You'll see that things are done differently in Europe versus the US for the exact same product. Europe has outlawed some of the ingredients and some of the things that are done there, and they still do them here. So I think those are areas he's going to really focus on, and probably can get some of that done, where we're going to have hopefully healthier options in the United States from a food standpoint. The drug side is going to be much harder for him to tackle.
I remember very well during the first term, whenever Trump would back then tweet something, right? The market would react instantly, and it felt very much on edge. Maybe I'm wrong on this, but I don't get the sense that the market is on edge in the same way. Maybe it's just because we've already gone through first term with Trump, but I wonder if you think that Trump may have mellowed out a little bit, that because this is his last term, he wants to leave a legacy. And that means he's not going to be as erratic in some people's minds as maybe he was initially.
Well, I mean, I don't know about the term erratic, but I would say this, there was a period of time here for the last several weeks, including before the election, where he was, he wasn't out on social media as much as he had been, and certainly since the election, there were several weeks there where he's not been on social media. He's had his head down, working on the transition, getting people in place, spending a lot of time obviously at Mar-a-Lago with the transition team, and he just he looks to be, to me, very, very focused on January 20th hitting the ground running. And I think that's his focus. He wants his people in there. He's got the Senate for the confirmations. He's got the House. He knows he's got a period of time here to create a real legacy. I do think he's going to make good on the promise of reducing the size of government. And I do think he's going to focus on shutting down at least one of these entities, probably the Department of Education, because that would be a huge legacy. If you could say, hey, you actually shrunk government, you closed a government agency, which no one's ever done. And I think reducing the size of government and getting the regulations off of people's backs is going to be a huge focus of his legacy. And he knows to do that, he's got to be ready to go on day one, because there's such a finite period of time. He's obviously learned a lot from the first term, what it takes to get stuff through Congress, what it takes to get public approval and opinion on things, and he looks to me to be extremely focused on being a very successful second-term president, and then obviously making sure that prices come down for the average American, because that's been a big problem. The American people, if you look at middle income and lower income Americans, they're much poorer than they were. I mean, we can talk about inflation being up 2.5% and all this last year. Look, if you look at food prices in especially in fast food and other places, they're up way more than the reported inflation over the last 3 years. So the cost to live on a daily basis is much higher than just the overall average inflation, and that's really crushed middle income and low income Americans. And I think one of the best ways to get those down are, again, reduce regulations. You got to produce more supply of something at a lower price. Oil and gas is the obvious place for that, because it's in everything we do, whether you're transporting something or you're turning on the electricity. All of those things are driven by oil and gas. If you can get that down, you're going to see immediate drop in inflation. And I think, obviously, if we can get that, that would then give the Fed the ability to cut rates even further.
Speaking about inflation, I think it's good to kind of tease this out a little bit more. There is a concern that we're going to see another round of inflation and that Trump's going to add more fuel to that fire. I think it's becoming more clear the Fed may have made a mistake in cutting and declaring victory. Make the argument that the Trump administration could actually be more disinflationary, because I think everyone's assuming that his policies will just result in more inflation over growth. Maybe we have more growth over inflation.
Well, look, this Fed has been wrong a lot. I've called it out publicly. For those that don't know me, I've been on Fox Business and CNBC and Fox News for years, really since I launched the fund, about 7 years. I was calling out the Fed when they started raising rates during Trump's first term for no reason, like literally just the thought that there might be inflation. They started raising rates, and then I hammered them for the whole time they were doing it. And then, of course, they immediately had to start cutting rates because they got that wrong. And then, you start looking at the fact that they were saying that inflation was transitory and they weren't raising rates. I mean, it just, and I was calling them out saying they need to be raising rates. Look, I think it's been politicized. I think Powell politicized it, quite frankly. And I think he cut rates going into the election because he was trying to help Kamala Harris. I mean, I just think that's what happened. If you looked at the numbers, it certainly didn't justify a 50 basis point cut the first time. And he's done these things, again, I think for political reasons. And so I don't have a lot of confidence in it. I don't know whether he'll continue to cut or not, but I think the Fed's interest rate moves certainly now are not what's going to determine whether we're going to have inflation or not. it is government spending. You print more money and you waste it, which quite frankly, I think there's been a lot of waste when you look at the, Inflation Reduction Act, which didn't reduce inflation, and you just spend it all on green energy and things like that. When you print money to put it into non-productive things, you're going to have inflation. When you print money and just hand it out to people coming across the border with cards that they can go spend money, that creates inflation. There was no productivity behind that printing of those dollar bills. So I think those things are going to come to an end. And the question is, will Congress with Trump look to reduce some of the non-productive spending? That's what Elon Musk and Vivek are going to try to weed out and look at, the government efficiency group. So I think they are focused on that. So there's a couple of things, right? You've got spending on non-productive things. The government needs to do certain things. We all know that. But when you print money and you put it in things that are actually destructive from a dollar standpoint, in other words, you spend $1 and you get 80 cents of return, that's a negative 20% when you print that dollar. And so that's why it's much better to have money stay in the private sector, where $1 could potentially be $1.20 of productivity. That's when you actually create GDP growth and you create wealth. When you destroy wealth is by printing money and using it in a non-productive way. So those are going to be the two things. And whether they can do that, we're going to see. I think I've got confidence that they will. Again, energy being a big factor in everything that we do. I think if you get that down, you will see some headline inflation come down. And again, if you can reduce regulations, again, that creates more productivity. But we're going to have to grow our way out of this deficit. Like we can't tax it. You can tax everybody 100% in the top brackets, and you can't even get a small dent in the deficit. Everyone knows we have to grow our way out of it. So that's going to be Trump's focus, is to grow the economy faster, create real GDP growth. You need it to be in the 3 to 4% range. And then you can start to see the deficit come down, which will give confidence in being able to have lower interest rates, because the dollar is still the only place to be. I mean, I don't recommend anybody going into Europe or Asia or any of these other places. The U.S. is the place to be. It's going to be the place to be for the next, for Trump's next term. And I think if the U.S. can get this right and Trump gets it right, we're going to have a great period of time here in the U.S.
I know one of the main things for Maga is obviously the screening out of woke companies and things of that nature. I want to touch on whether you think there might be a shift in spending patterns under a Trump administration, whereby you see more and more people supporting the more MAGA type of companies, supporting the more conservative type of companies with more of their own dollars, in the same way that the left has with some of their favorites.
Yeah, I mean, if you look at it, I think there's going to be a big movement away from the whole ESG thing. DEI looks like it's starting to crumble. And so again, I think my view is, I think those areas are productivity destroying, not productivity enhancing. So when you move away from those, you're going to increase the productivity of companies, because they're not going to be focused on the wrong things that don't do anything to help the bottom line. And as you do that, you end up with better companies, better stocks, better ways to earn money within the stock market. So, yeah, I think there is a movement that direction. You're seeing it. The fact that Trump won so decisively, I think has really caused the Democrats, and I put the Democrats in there, and there's the left. So the left and the Democrats, in my mind, are two different things, even though they're in the same party. The left is still kind of fighting the same battle and saying, it's not over. We're going to keep doing exactly what we did. We're not changing anything. And the normal Democrats are saying, look, we've got to reflect on this and figure out, like, hey, we've been off base with our focus, and we're focused on all these kind of crazy social issues that the majority of the country are not with us on. And we need to get back to focusing on normal things. I mean, I think there's nothing that any of us would like more than for our government to focus on, the economy, to focus on growing that economy, to focus on the defense of the country and the things that they can do to kind of get out of the way and let the private sector work properly, rather than interfering with the private sector with all of these social things that have nothing to do with what the majority of Americans are focused on or care about. And I think we're going to see a movement that direction. We're going to see it in corporate America. I think you're going to see it in these boards that are going to finally, hopefully, unless they're just completely hijacked, they're going to step in and go, guys, we're not going to spend half the board meeting talking about, what kind of transgender agenda we can put into the corporate manual to handle, bathrooms. Like honestly, that's the kind of stuff that's been going on, and it's completely disruptive and unproductive and not profitable for the companies. And they've been forced to do it because the government of the United States has been pushing that direction. That's over with, and I think people are going to be very relieved to move on from that. And I think you will see a completely different approach from corporate America. I mean, remember when Major League Baseball said we're not going to have the All-Star game in Atlanta because the legislature there passed more stringent voter ID laws. Okay, more people voted in Georgia in this election than they ever have, but yet they put out the narrative that it was going to suppress, it was a voter suppression bill, and that it was discriminatory, and that it was going to hurt the vote of African Americans and others by having an ID. I mean, this is how crazy corporate America had gotten. You're not going to see that anymore. And I think Disney's going to have to change what they're doing. You saw ABC come out and say we're going to have to put conservative voices on because they don't have any. We'll see if they do it. We'll see if it happens, and see if they come back a year from now and try to go back to their old ways. They're certainly going to get pushback from the left. The left is not going to want to move that direction. So there's going to be a battle inside the Democrat Party, and we're going to see who wins it. But they don't have any leadership now. If you look at it, they don't have any. Who would be the leader of the Democrat Party right now? And who would have thought this, 2 years ago? Everyone was like, oh, the Republicans are dead. They're not doing well. Look, they didn't even do the sweep in the midterms that they thought they would. No, the Republican Party now knows exactly who the leader is. It's Donald Trump. They know what his agenda is. They know what he's focused on, and the Democrats don't have one. So it'll be interesting to see, where companies come out on this. It looks to me like Jamie Dimon gets it. At JP Morgan, he was already kind of moving that direction, over the last 6 months, in saying, look, we've got to get focused on, business and the economy. And he was one of the first to say people need to get back to work. They can't be working from home, which, by the way, over half of our government does. A lot of these people don't go into the office. That's all going to change. So we're going to see a whole different approach here in the country. And again, I think it's going to be healthy. Because I think there's going to be a kind of a let's get your heads down and work and stop fighting about things that most people don't care about.
Let's talk about Maga a bit more. Talk about the methodology. I know we've talked about this before, but for those that are watching this for the first time, how are you even constructing the portfolio?
Yeah. So what I do is when I launched the Maga, it had to do with obviously the political climate back in 2017, where you had all these companies, coming out with these crazy policies and things like Disney and Target and all these different groups, and people were protesting these companies. And I'm thinking, well, you own these companies in your mutual funds, you don't even realize it, your 401ks. So I created this ETF, and I didn't want it to be me deciding, oh, is this company conservative or not? I took the companies in the S&P 500 and I screened it for the political contributions of the PACs and the employees of those companies. And I wanted to look at where are they giving their money. They say one thing, but where are they actually supporting and giving money to on the federal side? These are all federal, and it's all public. So I screened and I took the top 150 Republican supporting companies, both on a net dollar basis and a net percentage basis. And I also added another screening in there a couple of years ago where at least half the assets of the companies need to be in the U.S. I wanted it to be the employees, at least half the employees in the U.S., but that data is not really readily public. Some companies report it, most don't. So I use assets as a proxy because I want this to be an America First ETF where companies are here, their assets are here, they're supporting America, and they're also supporting Republicans to get elected for Congress, for president, and so that's been the approach. And these companies are obviously all publicly traded, and they're politically active. And I think one of the reasons people have asked me, like, why is this? Why are these companies doing well, or what makes them do well? If you look at what goes on in DC, companies give money, employees give money to politicians, and there's clearly a reason for it. And I think the reason is that they want to be in the dialogue, they want to be in the mix, whether there's legislation coming out, regulatory things coming out. So they obviously get a benefit of being in the conversation with the elected officials, and I think it helps their companies. And so, I think that's one of the reasons they've done well. But I also wanted people to have a chance to invest in companies that shared their political views, and have a way to invest pretty easily, and not have it be me saying, oh, well, this company is conservative or not conservative. It's rules based. It's equally weighted. It's now been out 7 years. Track record's great in my opinion. It looks good to me, and I mean I launched it at $25 a share. It's since inception it's up 117%, including dividends. So I think the performance speaks for itself, and it's an easy way for clients and investors to make their investments match political views.
Is it fair to say that others that are looking at it from the standpoint of this can be a core position, that this could replace their S&P 500 type exposure?
I certainly think it could be. It's diversified enough. It's equally weighted. Again, coming from a portfolio manager background and managing money for a very long time, I wanted to create something that wasn't going to blow up a client. I didn't want it to be like, I don't view this as a portfolio where if the S&P is up 10, this is going to be down 10, right? I mean, I'm not saying that's impossible to happen, but it's unlikely. And so I deliberately constructed it to where, it wasn't going to be something that was going to be hugely negative. Now, if the S&P is down 30%, this certainly could be down, at that level too. I think unlikely. If the S&P is down that much, it's because tech got crushed. This has very little tech in it. So there's that. But again, I think it could be core, or what people could do, quite frankly, is they can construct around, okay, I've got a bunch of tech stocks here. Maybe they already have 2 or 3 holdings, Apple, Google, Facebook on their own individual stocks. They could add this ETF instead of adding the S&P 500, because the S&P 500 is going to be replicating some of those individual stock holdings they already have. So I think that's one aspect as well. And so, yeah, if you're overweight tech, which anyone that's been in the market probably is, I think this is a good complement because you're not adding that same exposure. You're adding a different exposure than what you get there. So I think you can use it both ways. You could decide, hey, I'm going to go with this, and I'm not going to even own the S&P 500. Or you could say, well, I already own tech, I already own the S&P, rather than continuing to add to those same basically tech holdings. I want to do something different. So I think you can do both with it.
Fund's been around for a while. Obviously, you're part of you built a larger firm, right, than just the ETF's assets under management. I think you've got around 27 million last I checked. Some individuals get nervous when they see relatively smaller funds that don't have billions in assets, because they're worried about liquidity. I think it's always worth talking about this point.
Yes.
Talk about volume and liquidity, because they're not the same.
Yeah. So, I had the same view, Michael, before I launched this ETF. And again, I'd been in the business a long time. I kind of was of the view, if an ETF doesn't have a lot of assets, it doesn't have a lot of liquidity. That's actually not the case. The liquidity is driven by the underlying liquidity of the securities in the fund. So you can have a $10 billion high yield ETF, and it can trade at, a bid-ask spread of a penny or 2 pennies for a long time. But as soon as there's a problem in the high yield market where bond prices drop and you've got spreads widening, that spread in that ETF will widen out big. And so the liquidity is not really driven by the size of the ETF. It's driven by the liquidity of the underlying. So if I'm the market maker, as an example, in this high yield example, and things are going along fine for a few years, and all of a sudden, instead of things trading at 85 cents and 82 cents and 83 cents, all of a sudden, boom, they could drop to 70 cents overnight. As the market maker, you have no idea if that could happen to you when you're trying to trade these securities. So to match the ETF trading volume. So you have to widen out the spread to make up for that risk. So that spread will widen out massively. It doesn't matter that there's $10 billion in it. Same thing with like leverage loans or small cap stocks that have less liquidity in general. You're going to have wider bid-ask spreads. These are the largest companies in the U.S. that are in this fund for the most part. So these are not small cap companies. So it's driven by the underlying liquidity, which is very strong. And so, if someone came in tomorrow and said, I want to buy $1 billion of this ETF, we could trade that at NAV and it wouldn't even move. So because the underlying securities are so large and so liquid. So that's really what drives liquidity. And so the underlying assets don't. And as you pointed out earlier, I have an RIA. So I have several $100 million of management and I have a VC side of my firm as well. So, I'm not going anywhere on this either. So it's, from that standpoint. So I'm not sitting here with this one ETF, trying to kind of hang on. It's simply something I've now had 7 years. And again, the liquidity of the underlying securities is very high. So that's really not a factor. The fact that the size of the ETF isn't as large as some people may like to see.
Yeah, no, I think that's critical to explain to viewers, listeners. I think a lot of people still, even though there's plenty of education around this, they still don't quite fully understand the liquidity dynamic. What, put your RIA hat on, what pairs well against Maga? I mean, if that's going to be a core allocation and you want to have, in general, a more conservative portfolio, are there certain other investment themes that you'd say, okay, it pairs up well against this or that?
Yeah, I mean, it's a good question. I mean, it depends on, again, this comes down to what, an individual client's looking for. It comes down to like the risk of what that client's looking for. So, what pairs well with it, I mean, I personally think that if you held the 4 or 5 kind of big cap tech stocks separately, individually, not through the S&P 500, and you paired Maga with it, I think that would pair interestingly well because, if we have a big run in tech, you're going to catch it with those individual stocks. If you have a big sell-off in tech, that money is going to go somewhere. I don't know that it runs into the bond market, but typically I think Maga will outperform the S&P 500 in that scenario because the S&P is heavy in tech. So I think those would kind of offset. And if you have both run, I think ultimately you're going to have other aspects of the market catch up. I mean, you've got companies now, as we know, $2-3 trillion market caps. Are they going to become $6 trillion market caps? I mean, at some point, you run into the law of large numbers with some of these names. They certainly are going to have, I think, could have good years. AI has really pushed some of these higher, and so there's that could continue. And obviously, data is king, and a lot of those companies have a lot of data. But I think that would be kind of a way to look at it, Michael, from a pairing standpoint. And then again, it depends on what those clients need or want to do. Whether they want more fixed income or they want, need some small cap. But I certainly wouldn't be fearful of owning Maga here. And I think, one thing I'd suggest is, what I typically do with ETFs is if someone's looking to buy it, I let the market open and stay open for about 30 to 45 minutes before trading any ETFs. S&P is a little different, but any kind of normal ETFs, you kind of let the market settle in and let the bid-ask spreads kind of get in there. And then I typically buy ETFs with a limit order. So I look out and go, and my experience in this is whatever you see as the bid on an ETF, a lot of times that's kind of the NAV. It's not always the case, but so let's say you have a bid of 51.50 and an ask of 51.56, so a 6 cent spread. That 51.50 is probably approximately where the NAV is, and so they're going to make they're going to sell at NAV and buy it or buy it at the 51.56 and sell it at 51.50. So that's the way to think about it. So you could put a limit order in and try to get an execution that way. And that's just, I think, a smart way to kind of play any kind of ETFs, unless they're just highly, penny bid-ask spreads a penny. You got S&P 500. That's pretty easy to do. But if you're doing any kind of sector ETFs or anything like that, I typically do those with limit orders.
It's a good question off of YouTube just came in. What's the portfolio turnover? How actively is Maga traded?
Yeah, good question. It's about 20% a year is the turnover. I rebalance quarterly. And so as new names are added to the index or taken out, if they're taken out of the index, which by the way, I use the Selective 500 now as the index, which is basically very similar to the S&P 500. It's just cheaper. But if it comes into the index, I'll screen it for its political contributions and its assets. If it makes sense to go in, it goes in. Something comes out of the index, I pull it, I rebalance quarterly, and then I do a full reconstitution every election cycle. So I will be looking at the political contributions for this last election cycle next spring. And that cycle is 2 years. So I'm going to look at all the political contributions these last 2 years, and we'll see where companies gave their money, where their PACs gave their money, where their employees. I pull that off, and I have a data scientist that pulls all the data for me. We look at it and reconstitute based on that. But that's the way it works. So you'll see a rebalance quarterly where everything goes back to equally weighted. In between quarters, it will run. So if you looked at my fact sheet at investpolitically.com, by the way, that's a good point. That the website for this is investpolitically.com. If you look at the fact sheet on there, or excuse me, the fact sheet or the current holdings, you'll typically see top 10. Those are going to be the top 10 that have moved up in value since the last rebalance. So again, it's not that meaningful. Like the number one holding could be 85 basis points or 90 basis points, but they'll get rebalanced back to equally weighted each quarter.
Hal, this has been a great conversation. For those who want to track you on social media or other places aside from the fund website, where would you point them to?
Yeah, well, I mean, I'm on Twitter. So at Maga Index is the Twitter holding. PointBridgeCapital.com is my website. And those are probably the two main places to find me. And I post my media videos both on PointBridge Capital's website and Invest Politically's website. And I have my own website, which is hal-lambert.com. So those are the places to find me. And I'm readily, my email's out there, hal.lambert@pointbridgecapital.com. So it's pretty easy to find me and kind of see what my views are. And, I'm probably due to be back on Fox Business or Fox News this week. So it's possible I'll be on this week. But I'm on pretty regularly.
Big fan of Hal and big fan of Mag. Everybody, make sure you learn more about that fund. Appreciate those that watch this. Again, this will be an edited podcast under Lead Lag Live. This is a sponsored conversation, and I'll see you all on the next episode. Thank you, Hal. Appreciate it.
Thank you.
Cheers, everybody.